All right, listen. If you have been watching gold lately, you have probably felt something weird. It doesn't just trend, it jolts. It spikes on headlines, reverses like it got yanked by a rope, then somehow ends up higher. And that makes a lot of people ask the same question. Is AI determining the gold price now? Because it feels like a machine. Fast, cold, almost too coordinated. So today we're going to take a wider look and answer this professionally without conspiracy, but also without pretending markets are still human. And I'll give you a clear conclusion at the end where AI matters, where it doesn't, and what that means for the future of gold. So let's speak the untold. When people say AI is determining gold, they usually mean one of three things. The first one is AI is trading gold, high frequency algorithms, pattern recognition. The second is AI is interpreting news faster than humans and reacting instantly. And number three is AI has become the dominant buyer, pushing long-term demand. So those are very different claims. And here is the key point. Gold has two different engines. Engine A, the micro engine, how price moves second to second. Engine B, the macro engine, why price ends up where it ends up over months and years. AI is strongest in engine A. But engine B, that's where the real story is. Let me say something that sounds simple but changes the whole frame. Most price discovery in gold happens in paper markets, OTC trading, futures, ETFs, where speed matters, leverage matters, and reaction time matters. The World Gold Council tracks trading volume across OTC, futures, and ETFs and emphasizes how liquid gold is as a financial asset with liquidity source, especially during stress. So when price whips around, often what you're watching is not gold, the metal. You're watching gold, the financial instrument. And those markets are already deeply automated. Not because it's evil, because it is profitable. Here is what AI and algorithms can realistically influence. They compress reaction time. If a headline drops at 12 sharp, humans might react at 30 seconds past 12. Algorithms react at 12 o'clock and 2/10 of a second. They amplify momentum. Once a move starts, models chase it. And if those models are trained on breakouts, they don't ask why. They just execute. They create mechanical sell-offs and rebounds. This is the part most people don't understand. In highly traded futures markets, automated systems plus leverage can produce cascading moves. The CFTC has studied automated trading in futures markets and discusses how much activity runs through electronic matching engines and automated behavior. So yes, AI can absolutely make gold look possessed in the short run. It can determine the route, but here is the important question. Is it determining the destination? Now we step back. The biggest long-term drivers of gold are borrowing. And borrowing is powerful. For example, central banks. The World Gold Council reports that central banks added 1,045 tons to global gold reserves in 2024 and demand topped 1,000 tons for the third year in a row. This is not AI. That is state strategy, and it matters because central banks don't day trade gold. They accumulate for reasons like reserve diversification, geopolitical risk, confidence hedging. That buying creates a long-term flow, total demand. World Gold Council data indicates that total gold demand in 2025, including OTC, exceeded 5,000 tons for the first time, and the gold price hit 53 new all-time highs that year. Again, this is not AI decided to like gold. This is a structural shift in global behavior. ETFs, that same report notes global gold ETF holdings grew 801 tons in 2025, one of the strongest years on record. That is long duration demand, not a microsecond model. So why does it feel like AI is in charge? Because in the short run, AI often is. Here is the most honest way to say it. AI determines the shape of volatility. Humans and institutions determine the direction of regimes. That is the wider look. And this is why people get confused. They watch a 10% drop and conclude the thesis is dead, but the drop was mechanical. The regime drivers are still there. And we have evidence that the market environment can produce extreme swings. Reuters recently described huge volatility in gold and silver in early 2026 with sharp moves and reversals. Volatility doesn't mean no fundamentals. Volatility often means the market is crowded. The real AI effect is not prediction, it's reflexes. Now I'm going to give you a scientific idea, simple but crucial. Markets are increasingly a reflexive system. A reflexive system is one where beliefs affect prices, prices affect beliefs, beliefs affect positioning, positioning affects prices again. AI models accelerate this reflex loop because they detect patterns faster, trade them faster, reinforce them faster. So AI doesn't need to understand gold, it only needs to understand other traders. And that's why gold can move on dollar strength, rate expectations, headline sentiment, positioning, options hedging, even when nothing about gold changed. So if you ask, is AI determining gold? The best answer is AI is determining how fast gold expresses whatever the market believes. What about the AI narrative itself? Here's a twist most people miss. AI may influence gold indirectly by changing the broader market. When AI drives productivity expectations, equity valuations, rate forecasts, and risk appetite, it changes the macro environment gold reacts to. So AI can shape the conditions that move gold, even if it isn't buying gold directly. This is subtle, but it is real. So, is AI determining the gold price? Now let's answer the question cleanly. Short term, partly yes. AI and automated systems significantly influence microstructure, the speed, the volatility, the intraday swings, and the cascade dynamics, especially in futures and other paper markets. Long term, no. The level where gold settles over months and years is still dominated by structural forces, central bank accumulation, like in the example of 2024, investment flows, and broad demand regimes. So here is the wider look answer. AI doesn't set gold's destination. AI changes the road you take to get there. And that matters because the road is getting bumpier. So finally, here is my prediction. Over the next few years, gold will increasingly behave like a hybrid asset. Macro anchored by sovereign and institutional demand, but micro whipped by automated trading and reflex loops, meaning you'll see more violent swings, while the long-term trend remains driven by reserve strategy and systemic confidence. So if gold feels AI-driven, you're not imagining it. But if you think AI owns gold, you are missing the bigger system, because the ultimate buyers that matter most aren't bots. They are central banks, they are institutions, they are states, and they don't trade in milliseconds, they trade in decades. That is the untold. If you want part 2, I'll do a full episode on the hidden mechanics that make gold move when nothing newsworthy happens, options hedging, positioning, and how paper gold can temporarily overpower physical demand. Until then, stay sharp, because markets don't just move, they communicate.